A look over here at Live Nations. We'll try to explain the MACD. So basically, it's just an oscillator here, Jay, that shows you negative momentum and positive momentum. So as it goes up, you get different kinds of things as far as the movement of it goes. I know there's these trend line. Basically, it's these. If you look at this, there's you can put the signals on, which I don't really look at, but basically what these lines are measuring is these two moving averages, and the farther they are away from each other, the more this line will go down, and in the respective direction. So when it's above the moving average, when one's above the other one, you'll have a positive reaction, and when one's below the other one, you'll have a negative reaction. And the greater that these lines are apart, the more momentum you have on there. So like I said, you don't really need these lines because it's already being shown on here. But what we're looking for is divergences. So like if I go over to Johnson & Johnson, this is basically what we're looking for here. Is you basically want to correlate it with price action. So price made a low, huge levels of negative momentum, right? Futzed around there, got positive momentum in this area, sold off again, right? And we made a lower low in this area than we did previously on that low. So when that happens, what we're looking for is divergences. So price is going one way, the momentum is going another way. So then you have what you have. This is class A bullish divergence. So that's when price action is making a lower low, but you're making way less levels of negative momentum. So the price got down there, but there wasn't as much force pushing it down there as there was in the previous low. And so what that indicates is that buyers are getting exhausted, or I'm sorry, sellers are getting exhausted at this area, and it might indicate price action reversal to the upside. So we're in a current trend going this way, down. You see divergence on both the oscillators, MACD and RSI, and then that gives you an edge of a possible reversal point. You can put that in there with coinciding variables of, say, like a really long support and resistance line that's been respected, a lot of times going back to the past. If you see that at an area of support, a critical area of support with divergences playing out, that's a good opportunity. That's an area of value. There's a good chance that the price might reverse like it did in here and go the other way. And that's what we're trying to catch. It also happens for the bearish side of things. Now this isn't the best example, but you can see price made a high, made a higher high, and then you got less positive momentum during that higher high. And while the MACD didn't reflect it at this peak, you can see the RSI made almost a quadruple divergence. So from this high to this high, there's definitely less pressure pushing that price up to those higher highs, so that would indicate that price might actually reverse at that point and go down. And this is a almost textbook example of divergences playing out on the daily, which is a significant time scale. On this specific one, we also saw it coinciding on the 4-hour in the exact same area, as you can see here. So we made a low, a lower low, a lower low. So we made 3 lows on this view here, and then the MACD showed less negative momentum on that low, and then on the third low, even less, barely even any at this point here, just one little mark down. That would indicate exhaustion at a critical area of support on both the oscillators, on both major time scales. That's what we're looking for. So that's why we kind of look at the MACD when prices are falling or going up for edges and possibilities of reversals. And that's basically what we're trying to catch. So, hope that answered your question there, J.O. What do we got here?